soft landings are very rare and very difficult to generate. And some parts of the bond market, as you mentioned earlier, are also already signaling a problem with growth trajectories in the future. So even though the 3-month, 10-year rate is still not inverted and historically has had a lot of predictive power, there are some parts of the curve which are now inverted. In fact, according to our estimates, they are signaling around 40 to 50% chance of a recession. So the bond market curve shapes are already telling us that something is in the pipeline. And our own view is that this is a very narrow path. And in the next couple of months, if the Fed hawkishness doesn't pull back or at least stabilizes, then the risk of a recession, if they do carry out these hikes and the balance sheet runoff at $95 billion, which is now being indicated double the pace of last time around, then the chances of recession are going to go very, very significantly up going forward. At this moment in time, our base case is of a European recession, not a US one.
So why are we having a European recession, Salman, if we have negative rates still in Europe effectively, and it is a case of policy divergence between the central banks, with the ECB still continuing to argue that the inflationary pressures are different for Europe? Why are we worried about recession in Europe when it's the United States that sounds like it's got the aggressive monetary policy goal?
Jeff, this is a direct implication of the Russia-Ukraine war. So as we know, the energy dependence of Europe on Russia is significant. So 40% of gas supplies, around 25% of oil. So we are already seeing disruptions happening. So there are some pipeline flows which are going down. There is self-rationing happening in Germany and Austria. So please remember the 7.5% of EU GDP comes from the industrial sector, which is heavily reliant on Russian gas. And as the threat of gas disruptions has gone up, we have seen these rationings and shut-ins happen. So it's the industrial sector which is the problem in Europe. And if an actual disruption in the way that gas supplies basically fall to zero over a very short period of time happen, then we are going to see a significant reduction in GDP because these industries will have to be shut down. According to our estimates, Europe can deal with this for 3 to 4 months, but after that, they will run out of gas. And as we go closer to the winter season, this thing will become even worse because the swing in gas demand is around 2x. So it's really because of that interconnectivity and reliance on external energy supplies, which is the reason why we think Europe is much more vulnerable. And by the way, if you think about the high frequency data, it's also showing that it's Europe where the confidence is collapsing rather than the US right now, where hawkish policy is in place, not the volume disruptions we are thinking about in Europe.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.